My name is Ian Slattery from Zurich Investments, and firstly, thank you to Nick and the rest of the team at Alpha Wealth for inviting me to speak with you today. I'm just going to bring you through a quick update insofar of what we've seen in the first half of 2024 from an investment perspective and what we might expect to see going forward for the rest of this year. So looking at the year so far, if I turn to the main asset classes, if we look at equities, a very strong first 6 months of the year for equities, led by those magnificent 7 mega cap tech stocks who have been driven higher around the excitement of artificial intelligence, which has been supported by strong earnings, even as valuations have moved higher. What we also saw towards the second half of the first half, or the second quarter of the year, was a broadening out of that equity performance into other sectors, which is positive overall. Looking at a second of the key asset classes, when we look at fixed income, we now see sovereign bonds, credit and cash all very firmly in positive yielding territory. However, in terms of the price movements we saw in the first half of the year, very much flat to slightly negative, particularly in the Eurozone government bond space. Looking at currencies, and a key area here is the euro versus the US dollar, being very much in a tight trading range over the last 18 months. And we see the rate at around 108 to 109 euro to US dollar today. Another key area within some of our multi-asset funds is alternatives, which is namely commodities. And within that bucket, or that area of investment, gold has been a very strong performer in the first half of the year, very much in and around shifting interest rate expectations and geopolitical concerns. The big topic that we've continued to discuss for several years now is the path of inflation and ensuing impact on interest rates. And inflation globally, and indeed here in Ireland, continues to moderate or slow over the last 6 or 8 months. And we now expect to see further interest rate cuts in the second half of 2024. Economic momentum has remained resilient in the face of shifting landscape, and it looks like central banks have been managed to walk that tightrope between taming inflation without knocking the economic growth globally off. However, overall interest rate cuts, the expectation of interest rate cuts has moderated in the first half of the year. And what I mean by that is we're now not expecting as many interest rate cuts in the second half of the year as we might have expected at the turn of the year in and around Christmas 2023. So another piece to digest for market participants. In relation to geopolitical concerns, and indeed just political concerns, we've seen some major developments in the last number of weeks. Indeed, is the election of Labour in the UK. We saw the strong performance of the so-called far right in the European parliamentary elections, leading to a snap parliamentary election in France. And indeed, we've seen Donald Trump emerge as the front runner, not only for the Republican Party, but in terms of the front runner overall to be the next US president, with that election in November a key point in the calendar for the second half of this year. Putting some numbers on some of the points I've just made there, we look at the overall stock market, the global stock market here in blue, and we see Eurozone government bonds represented in the beige line. As I said, very strong for global stock markets, up 15% in 2024, whilst, as I mentioned already, just slightly negative but fairly flat performance for Eurozone government bonds, but still a good place to be in terms of providing that downside protection and indeed diversification within multi-asset funds. Looking at the performance of Zurich's equities, so our main international equity fund, which feeds into our multi-asset funds, has strongly outperformed the market, up 18% for the first half of 2024. We saw within our equity allocation a key focus on cyclical sectors such as tech and financials. In terms of the geographical basis, maintain a considerable allocation to the key US market, by far the biggest of all stock markets globally and the most influential. And some of the key themes which has aided performance in the first half of the year, there's the aforementioned excitement over AI, but also other areas, particularly in the US, in and around infrastructure, decarbonisation within the Eurozone, and more niche themes such as the development of treatments for things such as diabetes and obesity. Looking at government bonds, and we're going to take a slightly different tack here, we're looking at the yield on the key German 10-year bonds. So the yield moves in the opposite direction of price. So this has gone higher as prices have gone lower. But the key point here is we now see the yield on that key German bond above 2.5% versus just over 2% at the start of the year. And indeed, if I look back just 3 or 4 years ago, this key rate would have been in negative territory. So price action a little bit choppy in terms of the ups and downs in terms of the price you might get, but a real positive for multi-asset investors that this yield is firmly in positive territory. Within our own government bond books, we maintain a short duration position, and what I mean by that is less sensitivity to shifts in interest rate expectations. And we maintain a preference for, on a geographical basis, of periphery, so countries such as Ireland, Portugal, Spain, Italy, Greece, over more core or traditional core countries such as the likes of Germany, the Netherlands, and Finland. Within corporate bonds, we're credit a more neutral stance in terms of our asset allocation. Looking at that key commodity of gold, as I said, a very strong performer in the first half of the year, but interestingly enough, most of that performance concentrated in March and April, very much a flat first 2 months of the year and a very flat last 2 months of the first half of the year in relation to May or June. A strong performer in terms of gold, and we retained a preference or an overweight position in gold, which has helped our performance as well. And as I mentioned already, that gold price action being driven by increased political and geopolitical uncertainty and more central bank purchases in relation to gold. In terms of weighing up the risks and the outlook overall, if I look at for the bulls or on the more positive side, that aforementioned soft landing, the balancing act between taming inflation and not knocking economic growth. And indeed, the Chinese economy hopefully will continue to re-accelerate in terms of growth as a key driver of not only global growth, but indeed more concentrated in the Asian markets. In terms of more cognizant of risks or for the bears, inflation, there's been many false dawns in terms of the battle to tame inflation. So we keep a very watchful eye on how that data develops. And indeed, the lagged effects of tight monetary policy in relation to just because interest rates aren't rising anymore, it doesn't mean we don't feel the effects of them on a daily basis. In summary, in terms of Zurich's outlook as an active manager, we maintain a broadly balanced asset allocation stance, but remain poised to act in terms of adding to either equities or bonds within multi-asset funds as opportunities arise. And indeed, as I've already mentioned, very cognizant of those key risks, such as the re-emergence of inflation and many geopolitical and political events in the second half of the year, which will garner much attention. So thank you very much for your time. Plenty of food for thought, hopefully. And if you have any questions at all, please do feel free to reach out to Nick or any of the team at Alpha Wealth. But for me, for now, thank you very much.